Well, I definitely think that the next year or 10 years will not look like the last year or 10 years. I think we've had a really great 10-year run, and I think we have to sort of modify our expectations a little bit and bring it down a little bit more.
We get through the next decade without a recession?
Well, that would be a goal, right? That would be a great goal. We got through the last 10 years without a recession.
I said, really?
Yeah.
And we said we really didn't have a bear market, though we got right up to the measure of it. You expect we'll have a bear market this decade?
Well, it's inevitable we'll have a bear market, right? Exactly, because human nature drives prices up and down, and at some point human nature will turn against it. The probability, though, of not having a recession is higher than not having a bear market because of the way the economy has changed. If you look back long enough ago in an agriculturally driven economy, weather drove markets and recessions. In an industrial economy, interest rates drove it. It's not altogether clear that interest rates have the same efficacy either on the upside or the downside in the modern economy.
You're both sort of in the camp that next year will probably be a year of high single-digit returns, 7 to 9%, something like that. Mostly driven, as I understand it, by earnings growth, not so much by multiple expansion. But what are the odds that next year looks much more volatile than this year was? And what are the odds, in your view, that we do have not a bear market, but a full-fledged, full-on 10% correction? We haven't had one of those in a long time.
Well, I would say that the odds aren't as great as they would be if we start correcting all of these uncertainties in the market. So the trade wars, with the tariffs being rolled back and some being, pushed down further or, just totally removed. I think if those things are out of the market and the clients or the individual consumers have confidence in the market and they're still spending,
probability that there won't be a correction.
They'll spend their money, and as long as people are spending money, the markets do well.
So what sector should I put my money in for next year?
Well, we would say for us, we like consumer discretionary and we like communication services. We think that those are two areas that should be strong. Consumer services can give you the upside and the downside. They can protect. Some of the telecom can give you nice dividends too. And then emerging markets, say maybe, we're adding about 3% toward emerging markets. We think that with some of these things settling in, there's opportunities for growth there, and it's a little bit undervalued.
How about you, Scott?
The thing to watch for next year in terms of a source of volatility is probably actions by the Fed, and not the kind you anticipate, not the Fed deciding to raise interest rates or lower interest rates, but it's balance sheet operations. If you look at the fact that the Fed balance sheet is up almost $380 billion in the past quarter, that's why we're ending the year on a strong note. There's a lot of liquidity out there.
$3.5 trillion added to the Fed's balance sheet, I think it is this year.
It could easily, the balance sheet could be at a new high by this time at the end of the first
And by the way, $160 billion, I think, in repo operations on January 30th or 31st, another $160 billion on the first day of 2020.
Yeah.
Why do they need to add $320 billion to liquidity in basically the cash system of the banking plumbing if everything's fine?
It's a really good idea, and I think it's another way for the Fed to buy an insurance policy. My culprit for potential volatility next year would be something in that inner workings of the Fed. It's very esoteric. It's inside baseball. It's not interest rates going up or down. Watch that. To answer, Tyler, your question, we like the strength of the consumer as well. It's sort of a boring story. It's a 10-year-old story now, but as long as the labor market's healthy, the housing market is healthy, those are tailwinds to consumption. Consumer-type stocks are probably going to lead the way.
And I would just say, too, we're trying to guide our clients into sustainable investing, into the areas of the markets where we think the puck is moving versus where the puck is right now. And that would include robotics, artificial intelligence, helping to sustain, like, the water scarcity and things like that.
All right.